Hello dear students, in the previous video on Industrial Economics MCQ series part 1, I had covered 3 chapters, that is first, second and fourth. In this video, I am going to cover rest of the chapters. So dear learners, I have really worked hard to compile the question bank on your request on Industrial Economics. So please like it, and if you have not subscribed my channel yet, please subscribe it. The channel link is given here. So let us begin without wasting much time. First question, the organization that currently establishes the rule of conduct for firms engaging in international trade is World Bank, International Trade Commission, Department of Justice, World Trade Organization. The correct answer is World Trade Organization. It was established in 1995. Next question, the exchange rate system that best characterizes the present international monetary arrangement used by industrialized countries is freely fluctuating exchange rate, adjustable pegged exchange rates, managed floating exchange rates, pegged or fixed exchange rate. Correct answer is managed floating exchange rate. Most of the industrialized countries are using managed floating exchange rate. Which exchange rate mechanism calls for frequent redefining of the par value by small amounts to remove a payment's disequilibrium? A dual exchange rate, adjustable pegged exchange rate, managed floating exchange rate, crawling pegged exchange rate. Correct answer is crawling pegged exchange rates. Under managed floating exchange rate, if the rate of inflation in the United States is less than the rate of inflation of its trading partners, the dollar will likely appreciate against foreign currencies, depreciate against foreign currencies, be officially revalued by the government, be officially devalued by the government. Correct answer is it will appreciate against the foreign currencies if the rate of inflation in United States is less than the rate of inflation of its trading partners. Next, under adjustable pegged rates, if the rate of inflation in the United States exceeds the rate of inflation in United States exceeds the rate of inflation of its trading partners, US exports tend to rise and imports tend to fall. B, US imports tend to rise and exports tend to fall. US foreign exchange reserves tend to rise, US foreign exchange reserves remain constant. The correct answer is US imports tend to rise because the rate of inflation in United States is more, so import goods would become cheaper. Next, which exchange rate does not require monetary reserves for official exchange rate intervention? Floating exchange rate, pegged exchange rate, managed floating exchange rate, dual exchange rate. Correct answer is floating exchange rate. There is no need to manage foreign exchange reserves. Next, small nations whose trade and financial relationships are mainly with a single partner tend to utilize pegged exchange rate, freely floating exchange rate, managed floating exchange rate, crawling exchange rate. The correct answer is pegged exchange rate, that is fixed exchange rate. Next, small nations with more than one major trading partner tend to peg the value of their currencies to gold, silver, single currency or a basket of currencies. So small nation will peg it with basket of currencies. Next, a country that is a net international debtor initially experiences a larger saving pool available to finance domestic spending. High interest rate which leads to lower domestic investment, low loss of funds to trading partners overseas, decrease in service exports to other countries. Correct answer is larger saving pools will be available initially with the international debtor country. Next question, credit items in the balance of payments correspond to anything that involves receipts from foreigners, involve payments to foreigners, increases the domestic money supply, decreases the demand for foreign exchange. Correct answer is it involves receipts from foreigners. If debit item is there, then it will involve payment to foreigners. So correct answer is receives from foreigners when there is credit. Next, when all the debit or credit items in the balance of payments are combined, merchandise imports and equal the merchandise exports, capital imports equal capital exports, service export equals service imports, and the total surplus or deficit equals 0. The correct answer is D, that is, it would be equal to 0. All of the following are credit items in the balance of payments except investment flows, merchandise exports, payments for Indian overseas to foreigners, private gifts to foreign residents. So these first three are the credit items in the balance of payment except this private gifts to foreign residents. This is not credit, this will be debit. Next question, all of the following are debit items in the balance of payment except capital outflows, merchandise exports, private gift to foreigners, foreign aid granted to other nations. The correct answer is merchandise export. This is in fact credit item, not the debit item. So correct answer is this, debit item in the balance except this one. This one is credit item. So B is the correct answer. Next, a capital account surplus might be expected to cause a current account deficit because the associated capital outflow would cause the nation's currency to depreciate, contributing to trade deficit. Capital inflow would cause the nation's currency to depreciate, contributing to trade deficit. Or capital inflow would cause the nation's currency to appreciate and contributing to a trade deficit. A capital outflow cause the nation's currency to appreciate, contributing to trade deficit. So capital account surplus might be expected to cause current account, capital flow would cause the nation's currency to appreciate because and contributing to trade deficit because currency would be coming in the form of capital account, maybe FDI loans, and it will contribute to trade deficit. Next question, the role of dash is to direct one's nation's savings into investment of another nation. The correct answer, merchandise trade flows, service flows, current account flows, capital flows. The role of capital flows is to direct one nation's saving into investment of other, right? If something is saved here and if moves out from say America to India, that will be capital flow from America to India. So that is investment in India and that is capital outflow from America. So correct answer is D. Next, current account includes the value of trade in merchandise, services, unilateral transfers, all of the above. Correct answer is all of the above. Current account deficit are offset by merchandise trade deficit, merchandise trade surpluses, capital / financial account surpluses, capital financial account deficit. Correct answer is this, current account deficit are offset by capital and financial account surpluses. The balance of trade is a record of exports and imports of financial asset, current account surplus, current account plus capital account, the net export of goods and services, the value of merchandise exports minus imports, that is balance of trade. So correct answer is D. Next, direct investment and security purchases are classified as capital account transaction, current account transaction, unilateral transfer transactions, merchandise trade transactions. So correct answer is direct investment and security purchases are classified as capital account transactions. The supply of foreign currency tends to be upward sloping, downward sloping, vertical, any of the above. So supply of foreign currency tends to be upward sloping. There is direct relation. Higher the exchange rate, higher will be the supply. Lower the exchange rate, lower will be the supply. So upward sloping supply of foreign currency. Next, the exchange rate is kept the same across geographical separate markets by hedging, speculation, government regulation, arbitrage. It is arbitrages or arbitrage. The exchange rate is kept same across the geographical boundaries. Next, the reduction or covering of foreign exchange risk is called hedging. Speculation, intervention, arbitrage, it is known as hedging. Next, the difference between bid or buying rates and ask or selling rate is called profit, arbitrage, spread, and forward transaction. It is called as spread. Next, riskless transactions to take advantage of profit opportunities due to a price differential or a yield differential in excess of transaction costs are called differential actions, cash transactions, arbitrage, forward transaction. It is called arbitrage. So next question, the essential feature of a dash is that it immediately fixes the rate at which a specified amount of one currency is to be delivered in exchange for a specific amount of another at a future date. Forward contract, spot contract, money contract, bid contract. Correct answer is forward contract because it is on a future date. Next, speculators in foreign exchange markets do all of the following except attempt to profit by trading on expectation about future currency prices, bear risk as they attempt to beat the market, attempt to buy currency at a low price and later resell the currency at a higher price, simultaneously buy a currency at a low price and sell that currency at a higher price, making a riskless profit. So the correct answer here is this. So speculator in foreign exchange markets do all these first three. They don't do this last one. So the correct answer is D. Next, the relationship between the exchange rate and the prices of tradable goods is known as the purchasing power parity theory, asset markets theory, monetary theory, balance of payment theory. The correct answer is triple P theory, that is purchasing power parity theory, exchange rate and price of tradable goods. Relation is explained by purchasing power parity theory. Next one, a relatively low real interest rate in the United States tend to decrease the foreign demand for dollars, causing the dollar to depreciate, decrease the foreign demand for dollars, causing the dollar to appreciate, increase the foreign demand for dollars, causing the dollar to depreciate, increase the foreign demand for dollars, causing the dollar to appreciate. The correct answer is relatively low interest rate in the United States tend to decrease the foreign demand for dollars, and this will cause the dollar to depreciate. Whereas if the relatively higher real interest rate will increase the foreign demand for dollars and causing dollar to appreciate. So this first one is the correct answer. Next, when the price of foreign currency, that is the exchange rate, is below the equilibrium level, when price of foreign currency is below the equilibrium level, there will be an excess demand for currency exists in the foreign exchange market, and excess supply of currency exists in the foreign exchange market. Demand for foreign exchange shifts outward to the right, demand for foreign exchange shifts backward to the left. The correct answer is this. In fact, what happens when it is below the equilibrium level, there will be excess demand for the currency more than the supply, right? If it is above the equilibrium level, then there will be excess supply of currency and demand for it will be less. So here correct answer is A. Next, given a system of floating exchange rate, rising income in India would trigger increase in the demand for imports and increase in the demand for foreign currency, increase in demand for imports and decrease in demand for foreign currency, decrease in demand for imports, increase in demand for foreign currency, decrease in demand for imports and decrease in demand for foreign currency. Here the correct answer is this. Under the floating exchange rate, if income in India is rising, import demand will increase and this will increase the demand for foreign currency, right? Contrary to this, if there is falling income, then in this case there will be decrease in demand for imports and decrease in demand for foreign currency will take place. So here the correct answer is the first one, A. Next, under a system of floating exchange rates, relatively low productivity and high inflation in the United States results in increase in the demand for foreign currency and decrease in the supply of foreign currency and a depreciation in the dollar. This is the correct answer. In fact, under the floating exchange rate system, low productivity and higher inflation will increase the demand for foreign currency and decrease the supply of foreign currency, and dollar will depreciate. Next, the notion that following a currency depreciation, the balance of trade falls for a while before increasing is called a dash effect. Relative price effect, elasticity, J-curve, pass through. The correct answer is J-curve effect. Initially, after depreciation, it falls and balance of trade falls, then again it starts increasing. Next, the extent to which a change in the exchange rate leads to changes in import and export prices is known as J-curve effect, Marshall-Lerner effect, absorption effect, pass-through effect. In fact, it is known as pass-through effect. Next, firms undertake multinational operations in order to hire low-income workers. Manufacturing nations, they have difficulty exporting to obtain necessary factor inputs. All of the above. Correct answer is all of the above. Firms undertake multinational operations in order to take advantage of all these things. Next, dash refers to the price charged for products sold to a subsidiary to a multinational corporation by another subsidiary in another country. Marginal cost pricing, full cost pricing, price discrimination, transfer pricing. Correct answer is transfer pricing refers to the price charged for the product sold to a subsidiary to a multinational corporation by another subsidiary in another country. Next question, which of the following is not an example of foreign direct investment? Construction of new auto assembly plant overseas, acquisition of an existing steel mill overseas, purchase of bonds or stock issued by a textile company overseas, creation of wholly owned business firms. So these first two and the last one are example of foreign direct investment, and this one is not the example. So C is the correct answer. The terms of trade is given by the prices paid for all goods exported by the home country, receipt for all goods exported by the home country, receipt for exports, and paid for imports or of primary product as opposed to manufactured products. Correct answer is terms of trade is given by the prices received for exports and paid for imports. If a country imposes an import tariff, its welfare can improve if the country is a small country rather than a large country. Its terms of trade improve enough, the tariff enhances the welfare of its trading partner, its government tax revenue increases because of the tariff. So the correct answer is if country imposes an import tariff and its welfare can improve only if its terms of trade improve enough. Only then this imposition of tariff will benefit. Next, gross barter terms of trade is a ratio of total physical quantities of import to the relative changes of export of a given country, total physical quantities of import to the total physical quantities of exports of a given country, relative changes of import to the total physical quantities of export of a given country. None of the above. Correct answer is gross barter includes total physical quantities of import to the total physical quantities of exports ratio. So correct answer is B. So all the best, students. Stay connected. The world is like a village now. Anytime, anywhere, anyone can make a positive difference in our life. So subscribe and press the bell icon for more useful videos on personal finance, career guidance and jobs. Thanks for watching.